In India, how many salaried income makers can actually afford to buy a house downright through cash payment? Then comes the loan paperwork. Multiple calls, multiple verification. Months have just flown by before even the interior work can begin. And in interiors itself, you have various options that are available that can really confuse a normal end user. And finally, once the house is ready for getting it for rent, getting the right broker and getting the right tenant itself is a big ordeal in itself. So to sum it up, while there is value in taking a home loan and acquiring a property and giving it for rent, the entire process can become cumbersome and there are several overheads that can really add up. This is where a poor man's cover call comes into play, where we can do all these things in a jiffy from the comfort of our laptop or a mobile and have a decent plan that can help us earn money while we are doing other activities. This is a cool way to generate passive income, provided we have understood all the nitty-gritties in depth.
Subscribe to the channel and hit like as your daily commitment to bite-sized learning that compounds your financial knowledge and takes you one step closer to financial freedom. Today's discussion will come under the foray of strategy and product knowledge, behavioral finance, regulatory and structural knowledge, portfolio construction and asset allocation. This is a part of the Financial Flywheel through Capital Mastery program. We will approach the poor man's covered call through three powerful prisms: the psychological or the mental model, how investors can think about leverage, ownership, and rent-like income; statistical or the probabilistic view, where we understand the risk, reward, probability of profit through data. We design a flowchart mapping the exact step-by-step process in a clear visual flow. We will be touching upon only a couple of design considerations. Since Financial Flywheel is all about bite-sized regular learnings that move towards financial freedom, we will use case studies subsequently, which will also cover the poor man's covered call strategy. Each case study subsequently will let us zoom in on detailed flowchart design considerations, and the intent is to make complex strategies simple, repeatable, and actionable. Psychologically or mentally, think of buying a house. You don't pay the full price, you put a down payment in the context of the home loan. The bank funds the rest, and you carry the risk if property prices dip in the short term, at which point in time you don't panic. You hold it because you expect a long-term growth. That is the mental model behind the poor man's covered call. Instead of buying the entire stock, you buy a deep in the money leap call, which is your down payment. Then you sell a far out of the money monthly call, which acts as your rental check. But mindset is everything. Just like property, we need patience, the right expectations. Short-term dips can happen. What matters is picking the right underlying. So, obviously, cyclical plays like commodities are not a good fit at all. However, indices like Nifty or select growth stocks with long-term potential are definitely much better candidates. The poor man's covered call is all about control, steady income, and staying the course. A lighter, smarter way to own property in the market without locking up the entire fund. Now let's develop a mathematical angle. We buy a far-dated, deep in the money leap call for three reasons. Number one, like insurance, time reduces cost. As days pass, premium decays. Two, deep in the money has the least time decay, especially with more than 100 days to expire. Three, by rolling every 2 months into the next available leap, usually in India, the leap contracts are December, March, and June. We manage liquidity while keeping the long exposure intact. We should understand that these contracts are in general illiquid, especially when they're in the money. But even if they're illiquid, we can go ahead and purchase them and adjust it through the rental income that we will make. On the income side, we sell a short-term call option more than 2 to 3 sigmas away. This is because of the risk capacity of the individual. More than 2 sigma away is satisfactory for some. Some can also go beyond 2 sigma. Since it is a short term, the liquidity is going to be very high, so the bid and ask spread is also going to be fairly low. Statistically, the chances of it turning in the money is low, but if it does become low, the long leap compensates for the short call loss, keeping us totally covered. Okay, now let us look at it from a flowchart design perspective. If the market drops, yes, the leap will show a temporary notional loss. But since our thesis is long-term growth in the underlying, we continue to pocket rent from the short calls and keep rolling into the fresh leaps. That is the structural beauty of the poor man's covered call. Low decay, steady income, and controlled downside, all built on long-term conviction of the underlying. In a poor man covers call, what happens is the market rallies past our sold short call. This way, the strategy is self-correcting if the market moves sharply up or goes down. The lead cushions the short call if the market drifts or dips. We continue to pocket monthly rental income. The key is discipline. Roll the lead every couple of months. Keep selling calls beyond 2 sigma and let the structure generate consistent cash flow. It is just like owning a property and re-leasing it whenever the tenant leaves.